You could be making money in the market, but still losing thousands of dollars because of one silent mistake. Now, most investors, they focus on growing their portfolio, but they don't realize the IRS might be taking a bigger cut than necessary. And the worst part, it all comes down to when you sell. One wrong move could nearly double your tax bill, and most people don't even know that they're doing it. But more on that here in a minute. First, let's discuss tax advantage accounts, because that matters quite a bit more than you may realize. Now, you might be doing everything right, but if you're ignoring tax advantage accounts like IRAs or 401ks, the government is quietly taking a big cut of your investment gains. These accounts are designed to help your investments grow faster because they reduce or they delay taxes. With a traditional IRA or 401k, you don't pay taxes on your earnings until you withdraw the money, usually in retirement when your tax rate could be lower. Meanwhile, a Roth IRA allows you to pay taxes up front, but then your investments grow and can be withdrawn completely tax-free. Now, here's why this matters so much in 2025. You can contribute up to $7,000 annually if you're under 50 years old to these IRAs. Starting early and letting that money compound without, all the yearly tax hits will mean hundreds of thousands of dollars more by retirement compared to investing the same amount into a taxable account where gains and dividends get taxed annually every single time that you sell something. So before you invest in that brokerage account, my question to you is, are you maxing out these tax advantage accounts?
Of course not.
Well, if not, you should be.
Keep in mind that if you're 25 today and max out a Roth IRA every year, assuming a 7% return, you'd be looking at over $1 million by age 65, all tax-free.
Exactly, Tiara. Time is their friend, and the earlier that you start, the better, right? This one step alone can make a gigantic difference in how much money you keep long-term. And this is just the start, right? Wait until you hear the next tax mistake that most people are missing. Now, most investors, they don't realize that they can turn losing investments into tax savings with something called tax loss harvesting. So here's how it works. So if you sell an investment that's dropped in value, you can use that loss to offset any gains that you made elsewhere. So for example, say that you made $7,000 when you sold NVIDIA, but lost $4,000 when you sold Meta stock. Those losses from Meta can wipe out part of your gains from NVIDIA, meaning that you only pay taxes on $3,000 instead of the full $7,000. Now, it may not seem like much, but if you do this yearly, it makes a huge difference over time. And even better, if your losses exceed your gains, you can actually use up to $3,000 of losses each year to reduce your regular taxable income. And if you still have leftover losses, you can carry them forward to future years. Now, I have to say, if tips like this, right here are opening your eyes, well, make sure that you subscribe, as I have some seriously helpful videos that you'll want to see in the coming weeks coming up here. That said, if you do tax loss harvesting, watch out for the wash sale rule and don't violate it. So this comes into play if you buy the same or very similar investment within 30 days before or after you sell it for a loss. The IRS disallows that loss, and you may miss the tax benefit. Now, ignoring this simple strategy means leaving money on the table every tax season. So up next here, let's focus on how misunderstanding capital gains taxes can also quietly destroy your returns. So do you think that all investment profits get taxed the same? Well, not even close. This is one of the easiest ways that investors can shoot themselves in the foot, and one mistake that can literally double your tax bill that I mentioned in the intro. So here's the thing. If you sell an investment that you've held for a year or less, you get hit with what they call a short-term capital gains tax, which is just your regular income tax rate. That could be as high as 37% for some folks. So hold on for more than a year and you shift that into long-term capital gains. That's where your tax rate drops way down. Most people will pay just 15%. Some will pay as little as 0%. It all really depends on your actual income. So let's say that you bought a stock and it shot up in 6 months. Well, cashing out fast might feel like a win, but if you're in a higher income bracket, you could owe a huge chunk to the IRS. Hang tight for a year and 1 day, and your tax bill could shrink by thousands. Patience pays off with capital gains taxes, but there's another tax surprise waiting for many investors. So even if you don't sell a share, dividends can quietly slash your returns if you're not careful. Let's get into that. So have you ever gotten that surprise at tax time when you see that you owe money just because your stocks paid out dividends? I've dealt with that. And here's why this catches so many investors off guard. Not all dividends are taxed the same way. And if you're not paying attention, the taxes on those payouts can quietly eat away at your returns. So dividends come in two different flavors, right? There's qualified and ordinary. Qualified dividends usually come from US companies and meet certain holding requirements, so they're taxed at a lower rate, 0, 15, or 20%, depending on how much you earn. Right? Now, most people, they land in the 15% bracket, which isn't too bad. But ordinary, non-qualified dividends, they get taxed as regular income, which could be as high as 37% if you're pulling in a bigger paycheck. So let's put this in perspective, right? So if you get $1,000 in qualified dividends, you might pay just $150 in tax. But if they're ordinary, non-qualified dividends, you could owe up to $370. That's real money out of your pocket each year, right? And knowing the difference in holding certain investments in the right tax advantaged account types, or at least understanding the tax impact, can mean keeping much more of your returns over time. So now you've just seen how taxes can quietly drain your investment gains, but there's a whole world of legal strategies that can actually reduce what you owe the IRS in the first place. So in this video right here, I dive into smart IRS approved methods to shrink your tax bill even further. So click on that and I'll see you right over there.